Startups looking for investment often turn to venture capital firms, but getting funding from these guys is renowned for being tricky to obtain, leaving lots of founders feeling rejected. We're here today with investment managers Luke and Paul and lead startup consultant Dan to discuss exactly this. Why do so many applications to VCs get rejected? So let's kick off today's questions with the 3 most important things you need to get perfect when applying to a VC.
We've been talking a lot about that recently, is understanding what a VC is looking for. I think a lot of founders who are looking for investment are looking for investment in their exciting new project. And there's a danger that they will think that everyone is going to see the light and think how wonderful this project is. So there's a number of things you need to get in the right mindset for. And one, a VC is looking to make money. And that is what they're there for. That's with the people who you're meeting with. Their responsibility is to ensure that their fund or their organization makes money. They're not investing out of the goodness of their heart. So everything that you present to them, you need to keep that, I would say, in your mind's eye. Fundamentally, if you're not presenting something to them that they're confident is going to make money, they won't invest in you. And there's the added bit about, VCs only make money if your company makes money, but it's also incumbent on you to convince them that you are going to be able to make money, and that is going to give them a return on their investment.
I think that's a really good foundation, because all of your planning should happen off the back of that. If you know what their motivation is and what types of deals they're looking to do, then really it's up to you to give them the confidence that you can execute against that plan. I think to do that, it involves 2 things. Number 1 is preparation. So what evidence have you gathered against certain aspects of the business, customers, the market, your pricing, your model, and how are you going to organize that in a way that gives them confidence? And typically it's done with, again, very good preparation and actually speaking in a concise and matter-of-fact manner, not overselling it, not pretending it's bigger than it is, but actually just the quiet confidence of, this is why I think it's going to work. Here's the data I've prepared. And ultimately, to hit on Paul's point, they're not looking to not do deals. They're desperately looking to find the right deals. So you shouldn't have to oversell it if what you've presented is a well-prepared set of evidence. And then I think the final consideration is, don't take it personally. For them, it's a numbers game. For you, it should also be a numbers game. If you're putting all your hopes on one investor, you're allowing yourself to get, hurt by a single piece of feedback. If you're applying a process to investment and approaching many investors and getting a well-balanced view on your business, you should then have the confidence to propose it properly and go from there. So alignment into preparation, into kind of the final delivery, I guess, of what evidence you have to date that you can make a success of it, and don't tie it all on one person.
Yeah, that's a point I wanted to follow on. You mentioned, Luke, was about, although Nova, our intention is to deliver part of your team, the investors need to have confidence that you and your team, or you as an individual, are actually going to be able to deliver. And that's really important from a perspective of de-risking, which we might talk about later on. But one big risk is that you just can't deliver, or you can't evolve or adapt. So they're going to be looking for you to have experience, whether or not it's in you individually or through an advisory group or through your team, experience in the facets within the business, whether that's experience within the market or the problem space or the technical solution space, et cetera, et cetera. So they want to know that embodied within you and or your extended team is a group of people or a group of skills that are going to be able to deliver. And one of the things we're saying about mindset is that people are looking to invest in founders. It's not just about people, although we all individually get excited about new technical ideas and so on. They're looking to invest in people who are actually going to build a business that gives them a return on their investment.
A lot of very, very good points have been mentioned, both from Paul and Luke. And for me, just to add a couple of others that I consider as well, to reiterate, the founder is quite a very important piece of the puzzle, because ultimately, as Paul mentioned, what the bet is on from the VC's perspective or the investor's perspective is that the founder is able to execute and actually turn what they see and what they think is going to happen into a true reality. And the true best way to do that is to put yourself in the right positioning to come across as the founder that can do that. Of course, there are different facets and all kinds of different ways of analysing what the best mechanics are and the best kind of attributes are behind this. But ultimately, someone that is able to understand what the VC wants and then deliver on that is, for me, the most powerful thing. But it's also another piece of it is not necessarily just about you coming to them for money. It's about you asking and wanting the right deal, because it is a two-way street. It's not traditionally where it's looked at, where it's kind of a case where a VC would kind of just throw a big bag of money at you and then you just are expected to go off. The relationship's kind of changed as time's gone along with a lot of different investors, and you need to be able, to get the right investor for you is also something that's quite important. It's not necessarily just getting the right investor for the business.
Because again, the one thing a lot of VCs are looking for is companies that they can help. So we talked about this recently about making sure that the investors you're talking to want that you fit their profile, and you've got much more chance of being successful if you do more than that, and it's something that they can genuinely help you in. I think we've all watched Dragon's Den, where one of the investors has said, well, actually, I work in retail, I've got a lot of connections in retail, I can help you out. Because again, it's in their interest to be able to help you out. So they are less likely to invest in a company that they can't help, where they have to stand away from it. So what you're really looking for is, like Dan said, is a partnership. It's not just cash. It's not a bank loan where your bank ignores you. It's about a partnership going forward. And the point being as well, you also want them to follow on if you can. It's certainly an early stage if you're looking for investors who can and would be willing to follow on.
All right. So what do investors think about when reviewing an application?
Yeah, I think if we look at the applications that we get and we break down our decision tree, I'd say that a lot of applications we can't really understand. We don't really know what it is you're trying to do, who's trying to do it, and why it's needed at all. If you can't get that initial hook, that like brain hook into an idea, it's very difficult to take it any further. I'd say the second factor then is relevance. So we try to make it clear that we are early stage, seed stage technology businesses that want to co-found with people. We still get an enormous amount of non-relevant investment opportunities, stuff that's later stage, stuff that's not technology, stuff that, have they even read the website? And so making yourself relevant to the right investors and making yourself understandable is probably half the battle. Then, like Paul said, they're going to apply their own lens to this. And it probably is two things. What's in it for me? Where's the monetary return? And how could I help this deal? Because there's no point me taking it on, giving them a bunch of cash just to watch them flounder and not be able to add any strategy to that. So make it easy to understand, make it relevant. And as long as you're aligned with them in terms of you want to scale the business and you'd like at some point to exit the business, then that should be enough to get an initial conversation. Based on our experience, if you can do those three things, we will call you and talk to you on the off chance that you've got a great deal. If you're not easy to understand, it's not worth an investor's time. If you're not relevant, it's not worth their time. And if you are not aligned in wanting to grow the company, then a VC is not going to be interested. Once you do those three surprisingly simple sounding steps, I'd say that you have a really high chance of getting a meeting, especially if you've put in a little bit of research to understand why your business fits with them, stage, market, have they done deals in the last 12 months? These things you can consider.
Yeah, that ties in really nicely with our last discussion about elevator pitches and how it's important to make sure your elevator pitch is really clear, it's really understandable, so people can understand your proposition and they can understand what your startup is in a nutshell.
And I think that's the point so important for that. The conceptually, it feels like it's do I get it? Do I trust this person? Do I like them? So it is important. They're looking, whether they're doing it consciously or subconsciously, VCs are looking for the right people? Do I trust this person? Is what they're saying reasonable? Are they, are they just taking the mick, or do they understand what they're talking about? And then again, the money. So there's a number of factors, but I think certainly subconsciously there's that thing about, do I trust this person as well? In our we actually, we have a checklist of what we think of the founders and so on. But I think the trust in the individual and their experience and their knowledge in the industry is important. But that, again, that should come across. If they can explain what it is, the idea is, then you're certainly going to be able to trust them a lot more if they can actually explain it in the first place.
Yeah, absolutely. And I think the last point on approaching VCs is it might feel as if they're going to make all of their decisions in that one pitch meeting that you have, when in fact you want to observe someone over a period of time, engaging in different activities and seeing how they respond. It's seeing them over this little period and seeing if they can generate momentum, I think, that will build trust, as Paul describes. It's very easy to try and push too hard in the first meeting to make that entire relationship. Typically, we like to meet someone, give them some feedback, and see how they respond to that feedback. And that gives us a really good indication of how committed they are to the business, how flexible they are when it comes to feedback, and how they're going to be to work with post-investment. So it's often as well not just about that first impression, but are you following up with these people? Are you taking it off your own back to give them an update on where your company's up to? Are you being kind of vulnerable with the challenges that you're facing and how you're overcoming them? If you can't build that trust over those few weeks, they won't take you into the further processes. They won't take you into diligence, because they have to vouch for you at a certain point. They're going to have to talk to their other partners that you're worth investing in. So they're going to need, a small period of time to see how you react. So you can be really proactive in this period and don't wait for them to come back to you. Reach out, tell them what you're up to, tell them how you're getting over challenges, and it'll make it much easier for them to advocate on your behalf if they understand that the highs and the lows, and how you're working through.
That's a really interesting point. You mentioned the diligence side of things and kind of how we look and consider investments at that kind of point once someone has managed to successfully get to that point. And I think the big undertone here that VCs really are considering is the element of risk to their capital, which goes back to kind of what Paul was iterating with making money. And the risk profiles can be across all of the entire spectrum of a startup, whether it is a lot of founder risk to the point, some of the points that we've just mentioned. But when these conversations do occur, it's very easy for a founder to get some form of feedback based on what the investor could potentially see as the biggest risk, whether it is a market risk or a product risk or potentially a competitional risk. There's all different variants. But some of the strongest founders that tend to keep these conversations maintained with the VCs is to actually go out and address these factors whilst having these conversations. Because as Luke said, if someone explains to you this is a risk of why they're not considering doing an investment, during the time when they're doing this kind of thinking time, which a lot of VCs tend to do, you can go out there and actually validate and prove this and come back with robust evidence that suggests why you're right and why their thinking is wrong. And if in our experience of Nova, the founders that do this are 10x better, because they're the ones that have gone out and proven what we want to see. And it gives us as investors so much more confidence in you and your ability to deliver, and ultimately make not only yourself more wealthy in the startup, but us as your investor as well.
Okay, so what do you think makes an application weak or most likely to get rejected?
It goes back to kind of what Paul mentioned in the first question, which is around finding the right kind of alignment and finding the right VC, and Luke's touched on it as well as we've gone along. And the most likely rejection is going to usually occur on grounds that is just not your fault. It is inherently something that is just not suited to the VC. And there could be many different reasons as why, in terms of the deal time or the stage, if it's a very early stage company, if it's a Series A stage round. There's a lot of variance there. And often a VC is not going to do anything, say if it's an idea stage business and they're only looking for really big companies to invest in at that point. That's the fastest way to get a rejection, because it's inherently not for them. So being able to position yourself by understanding exactly the type of VC they are, the size of deals they do, what they've done historically, and that data that they've done with other deals and different startups that they've invested in. Getting that right from the day one is, for me, one of the biggest reasons why applications get rejected. And in Nova's case as well, Luke mentioned, for example, we invest only in tech companies that are able to solve a problem. And if you're coming to us, say, for example, with a lifestyle business or
industrial
piping or a flower shop or whatever it is, then as brilliant as that could sound, you could have the best flowers in the world and the best distribution model, but it's something that we are not geared to help you for and with. So on that basis, the alignment is absolutely critical. Otherwise, you're probably going to get rejected before you've even got your foot in the door.
Yeah. I mean, I think again, I apologize for going back to money. I think for mine, I think it's the quality of the profit and loss projections that people generate, not necessarily in like the values that they come out with, but the assumptions that they place around that. So one of the key aspects, which we didn't really go into about what you need to have if you're going to be pitching to someone who's going to invest in you, is something that indicates your business model from a financial. And I'm not just talking about how much money you're going to make, it's how much it's going to cost, how long it's going to take to break even, those sorts of things. So I think where they are weak, it's an immediate concern because this person you're hoping is going to be running this business and so on. Now, in early stage ones, it's very hard to come up with those figures, and even your business model is going to evolve. But fundamentally, if they're not able to answer questions around the assumptions that they've used to generate those projections and P&L, it invalidates it beyond repair. Really, it means that it's, we can't accept someone just plucking figures out of the air. It needs to be that they've done the market research, they know the size of the market, they know the size of the niche that they're looking for, they know what similar things cost, they've already spoken to people who've got idea, whatever those assumptions are or whatever evidence they got to back it is incredibly important, rather than just turning up with a hockey stick curve, which tends to happen a lot. You need to be able to justify that hockey stick curve because we see a lot of them.
Yeah, that makes, I think, if we assume that an application has fulfilled the criteria of what Dan and Paul have said, so it's relevant and there's a financial return, give you, I guess, the founders a few quick tips on other quick ways to turn off investors. Grammar mistakes. You wouldn't believe how many applications we get that aren't written properly. If you're considering this founder as a person who, they say a pitch to investors shows that you can pitch other people. And it's the same when you write to them. So if you write a poorly written email, then that tells me that's how you're going to interact with other people in the market, which isn't great.
Luke, can I just add to that as well?
Yeah, of course.
If they miscalculate.
Yeah,
so,
exactly.
I mean, it's just that level of attention to detail on really important stuff. Yeah, go on. Sorry, mate.
No, you're spot on. So attention to detail. Simple things like make it easy to read, make sure the grammar's right. Don't send emails that are 2 pages long. People won't read it. Try not to add in any personal reasons for investment. We get quite a lot of X Factor type stories about how, the bank let them down and then their business partner let them down and now they really need this. You don't want to walk into a deal with all that baggage, as harsh as that might sound. So if you've got that baggage, hide it away and pretend that you haven't, because you need to be ready to start a fresh relationship, not have hangovers from the past or how other investors have treated you.
Sob stories then.
Yeah, no sob stories. And then the third thing really is to start, if you want to start presenting your own opinions as fact, that will turn people off really quickly. It is absolutely fine to have an opinion or a hypothesis on where the market's going to go. But then you need to show which evidence you've got why you think that might be the case. If you present anything as a bit more of a solid opinion and you are not willing to take feedback on it or any sort of criticism, and that includes your business plan, you yourself, your own skills, where you think the market's going, what you think the value to users is, that will be an extremely quick way to turn people off. And it's because everyone wants to work with someone flexible, someone who's willing to tackle each situation differently, and by showing from the off that you're too set in your own ways, it's an instant indication that that might be true. And then secondly, you know, we know that you're not going to have perfect evidence. You're an early stage business. You might be proposing a technology or a business model that's never been implemented before, but you better have some evidence that what you're saying has some merit, because you're about to ask someone for multiple hundreds of thousands of pounds. The least you could do is find some third-party reports or talk to some customers who validate what you say. So be relevant, like Dan said, be financially aligned, like Paul said, and then like a job interview, bit of common sense, take a bit of time to write a personal application. Don't have any grammar mistakes. Don't make it too long. Don't make it too short. Don't make it emotional, and don't make it opinionated. Yeah,
I mean, and to follow up on some of them, I think one of the worst thing is that you've got your inherent knowledge, and therefore, like you said, you're presenting stuff as fact, which is your experience. But also don't get annoyed when you're challenged on that. It's like, well, no, actually, I've got 15 years experience in this, so I do know. You know, it's not questioning your integrity. It's basically just trying to make sure they understand it and that there's evidence there. And again, what you mentioned before, one of the interesting things was about coachability. I've seen so many quotes around this that the investors and are looking for people who are coachable, who they can work with, who are positive and not going to get aggressive if they're challenged in any way. It is a very high pressure situation. You're asking for a lot of money, and it's easy to get lost in that. But just remaining calm, composed, and like I said, straightforward and open. And if you don't know the answer to something, just say it.
Yeah, that's probably the most important thing you can do to build credibility. If you combine admitting you don't know with Dan's feedback about go do it whilst you're in the process,
I'll go find out.
Yeah, you'll come across as an unstoppable founder then, and that's when people want to work with you.
With that in mind, then, so going on from incredible founders, so what are some of the best applications that you've ever seen that have come through Nova?
I think all applications are obviously very different, but any good application, obviously, goes without saying, probably has everything we discussed earlier. So let's talk about what are some of the amplifiers, some of the things that make you excited. So yes, it's all relevant. It's not going to be a big waste of my time. What are the cool things that make you really want to get into a deal? I want to head off everything actually by saying that an application isn't great until you've met the person and your expectation has been met. So you'll read an application, you'll think it sounds great, but you really can't make a judgment until you've met that person. It's all within the same process. So the best applications for me are clear. Then they give me a few interesting drivers or an insight, and then I'll meet the person and they'll be incredibly coachable, flexible, and willing to discuss in depth the data they've got, the data they haven't got. So it always, sometimes you'll get a really well-written application, you don't get a good feeling from someone. Other times, the opposite happens, a bad application, and actually they're a great founder, but they're quite lucky to get the meeting. It means that we've had a slow month. So best application I've seen was a person who had, in essence, built the technology company without coding. So they had managed to pull together multiple third-party tools. They'd able to produce a service of a kind, and they were able to get interaction with their customer market. When I met him, he was incredibly coachable, really flexible, and entirely willing to revisit the value proposition to make sure that what we built was stable and we could invest in it and deliver the product later. So the reasons it was so great is A, he knew exactly what stage he was at. He built something, but he needed help scaling it. He was coachable despite having an extremely impressive background, having worked as head of one of the retail banks in the UK. So he was still prepared to leave his biases at the door and start again, so to speak, and build up the correct evidence base to go. So it was that coachability. It was the fact that he'd actually gone on his own and built something, and now he's asking people to invest in it rather than, I have an idea, please put some cash in. So literally, in an early stage, any evidence is gold dust. If you can combine I've done something, but I'm willing to go back on it to make sure we've got the right thing, then that for us is what the best application would be. And then he lived up to that. So he wrote the application like that, and then he acted like that. So my expectation was met when I went in, and we did the deal very quickly after that. So it's not so much what's on the initial application, it's how you respond after that. And to pick up on Paul's piece, it's a high pressure situation, and investors are within their rights to challenge you. And a lot of them will challenge you, even if they don't believe what they're saying. They want to see how you respond to a challenge. So the best application is being really prepared for the meeting after the application.
I think again that leads quite nicely onto what I was going to say, was about the enthusiasm, the realistic but optimistic founder, the passion, the driver, for the idea. And one of several of the best examples I've seen are where they've come in and they've done what we refer to as a minimum viable service. So what Luke was saying, where they've actually done something, it doesn't have to include technology, but they've actually provided some level of service to show that this is, and that shows a level of initiative, that they're already doing something. They're obviously willing to review it because they're working with Nova, but the fact that they're not entrepreneurs. These are people who've got off the sofa in their evening while they've got a day job and started doing something. And that's always very impressive, and it immediately gives investors a sense of de-risking. Again, we're going to keep going back to that, but it feels like it's de-risked because this person is going to lead this company. This isn't necessarily somebody who's just had an idea. This isn't an inventor. This is someone who's going to drive this company through all of the problems that we're going to come across as we develop that. And again, so yeah, somebody passionate, they are the leader. They are the leader. We want to see that people are going to lead. And for some people, it's just that's not what they want to do. So in that case, co-found, bring along somebody who is going to be that leader. Find somebody already, bring them along for the journey. So we have seen presentations from inventors who stood quietly while their co-founder has stood there and gone through the detail and explained everything in a very, very clear way. But at the same time, it's quite nice having the inventor or the ideas person in the background so they can be asked questions as well.
That's really interesting, because I can completely agree. We have seen all sorts of different kind of pitches from such a wide background of founders, and the point where Luke echoed about being the kind of right founder and we don't really truly know until we have the first meeting is very true. And often it's a case where we won't even know if the founder is the perfect person for investment until maybe even a bit later in the process, until more things have been discovered, and that relationship dynamic between the investor and Nova and the founder, of course, is really strong. For me, whilst there are all kind of different attributes of kind of what a best application can look like, the truth is what we're looking for is groundbreaking innovation, and that's what we're wanting to try and produce ultimately. So with that in mind, we're looking for something that's really, really interesting, that helps us stand out a little bit more in terms of applications that come through. If all of them are kind of very similar, then we need something that's going to help it stand out in more detail. Yeah. And this doesn't necessarily have to be your thing is going to be able to do X, Y, Z in the future, because what we want to really understand is what makes this proposition unique to every other person in the world that has thought up of the same idea. And that could be down to a variety of different factors. You as the founder really understand the domain, or the market opportunities really well because you know something that nobody else does know. And and kind of shining light on this is quite good in an application for us, because then when we see it, it helps you stand out above the rest. And most often, at least with the Nova process, we tend to reach out and try and speak to as many people as possible with their ideas. But if something stands out, then you're going to get more attention. And of course, if then, as Luke was saying, as you go through the kind of process of meeting us and developing out the idea and getting the evidence we would need for an investment, it really, really strengthens the application if you already understand a lot of the things you need to be doing. And for us, we can coach you and make sure that you're off in the right direction. But what ties this together is speed. some founders that are really strong and have a good application want us to reply, call us, email us, spam emails. Why are you not paying attention to us? And sometimes that can produce really strong applications because the founders are quite passionate and really, really eager to get going. Sometimes it doesn't always work out, and that's just a fact of the business that we're in, unfortunately. But for us, founders that demonstrate that real strive and determination to get something going always sells to us very well.
There was even when I was reviewing the applications for a short period of time, one that really stuck out to me. So like going back about, you wouldn't believe how many founders like submit applications just with like forgetting basic things like grammar and how to form sentences and paragraphs even and stuff, just basic like probably GCSE writing techniques. But I understand that not everyone is brilliant at writing. It is a skill, especially like doing quite a lot of like the content writing for Nova. Like it's something I've had to learn. So one application that really stuck out for me was when a founder, his application was to do with like video. So that was, his company was all around tech for video. Anyway, so he realized that he's not a strong writer. He's not very good at his, writing an application. So he put the bare minimum that was required on the application, made sure all the punctuation was right, literally like probably sentences. But what he attached with his application was so valuable. And he attached a video, and it wasn't an elevator pitch. It was a video explaining his idea. And he'd used the technology that he was proposing to invest in to create this video, and straight away you just felt sold because one, he's proven that this tech looks amazing. Two, he's explained the idea to me on levels that like I fully understand now because it's in the forefront. And just like thirdly, like it was just so creative, it stood out beyond everyone else's. So it's just, I think sometimes even thinking outside the box to make yourself be seen. So the next question. If I applied to Nova's startup program tomorrow or any other VCs in the UK, how likely is it that my application will get accepted?
I think before we went to that, it was something I was going to address earlier on, that although we're treating Nova as venture capital in the same filters as everyone else, they are quite different in how earlier stage Nova are looking to invest. So some of these conversations a bit more generic than it is with Nova specifically, because we will inherently co-found at a much earlier stage, which is a much riskier stage. So that may well affect the answer to that, because traditional VCs are usually looking for revenue generating companies with existing traction, which can validate their forecasts and stuff a lot more than we would. Yeah, so I think that's a variance. I think that there will be a significant difference between applying opportunity for Nova and a general VCs, and it's also about the scale of their deal flow. And one thing that will be affecting it at the moment is that VCs have been affected by coronavirus and the ultimate economic environment that's affecting the globe and will do for a few years now. I don't know to what extent. I have no idea. I don't have a crystal ball. I'm not gonna guess either. But your level of success at this stage will vary based upon a number of factors.
I think from our perspective, I think we meet about a quarter of the people who apply to us. Most of them again aren't relevant or aren't easy to understand. Of the quarter of the people we meet, so let's say that's 25%, I'd say half of them are invited to do a pitch session. So about 12%, about half of them are invited into diligence, so about 6%, and half of them will get invested in. So we're operating at about 2 to 3% of all applications will hopefully get to the point where they're offered a deal by us. So 1 in 100, fair number, I guess. But again, if everyone who applied to us was relevant and wrote the application properly, that number would be massively improved. So the good news for you as a founder is it's such a low bar right now. It shouldn't be difficult for you to set yourself apart. And if you define success as get a pitch, you could get that number up quite high. if you define success as receive an investment, it's always going to remain low because there are so many parts for the deal to fall down: valuation, diligence, alignment, good feeling, bad feeling, people leaving the team, so it's too hard to say, I want to beat the average percentage number for deals. All you can do is be as relevant as possible, so you waste as little of your own time as you can.
Because I think that I'm hoping that's what's going to come out of this conversation, is that I'm certain there are good deals that we are not seeing because they're not getting through the first hurdles, because they're making standard errors. So we do have to reduce the number and filter it down to people what we see. And it's quite possible that through simple errors or mistakes, we're not seeing them, because basically we've got to say, well, okay, well, this one, the numbers just don't add up and the spelling's terrible. That'd be an awful reason for us not to invest in a £20 million company. So and hopefully produce something that saves the world. It'd be crazy. So hopefully from this, people will understand a bit more clearly about the really simple things that you just need to get through the early stages.
Sure, and just to kind of add to that as well is the dynamic of kind of where Nova sits in terms of the whole startup life cycle. So traditionally, if it's a bit more of a later stage investor that would deploy its Series A, say 20 million or something, then their deal flow is going to be slightly different to what someone or a VC or an entity at the earlier stage of the funnel would look like. So for us, we happily speak to a lot of people that do genuinely just have a very, very strong idea and a problem. No product, not necessarily any revenue, not really many users. And because of that, more people fit that bubble. And because we are very agnostic to kind of in the initial stages of an application, what the startup is, as long as it's within the realms of technology and startup for an investment, it kind of skews the numbers for a lot of VCs at this stage. So yes, whilst the numbers we have are genuinely quite small, the reason being is because we do receive a higher volume of applications as opposed to, say, a traditional VC that invest at later rounds.
Okay. Why do we use a lean canvas for Nova's applications? Where does that tie into all of this?
It is fundamental, even at this very early stage, that founders are able to put together a business model. If nothing else, it's really good practice for them to understand what a business is. And providing a business model, whether or not it's a great business model, the fact they produced one shows that they understand what it is to build a business. As I said, there's lots of examples at a very early stage where people's arguing about whether or not, at this early stage, because we haven't decided exactly what the business is necessarily going to be, that it makes sense. But I genuinely think it's an incredibly powerful exercise for founders to go through. And as you'll see on our lean stack process, they get to do lots of them if need be, and to come up with their many ideas.
Yeah, absolutely. And the reason we use the lean canvas is so that we can very quickly access that information, get an idea of what you're thinking without having to read a business plan that's going to take us a day to read it, take you a week to write it. It's going to be out of date the second you write it, because I hope so. You're an early stage business, things should be changing quite quickly. So it's a very labor unintensive way for you to update us on where your current plans are. By design, you can only put a very small amount of information in the box. This gives us a great idea of what you're focusing on and whether or not you're aligned to what we think is important. And if in every box you've put something that we wouldn't consider important, but it is important to you, then it's a very fast way to see that we're probably not very aligned here. And what we can do is either offer our support on why we think our certain way, or we just agree right there and then that it's not for us. So there's about 100 reasons we use the lean canvas rather than a business plan. Extra stuff we can go into, but that's the crux of it, really. It's a very simple way to communicate what should be an ever-changing business.
Absolutely. And then to add to that, I suppose the second piece of that is the outcome, the what happens next. And the most powerful aspect of what the lean canvas can help you do is focus on the right thing at the right time, and not focusing on, for example, the solution or what the marketing strategy is going to be when you're trying to deploy to B2B companies later down the line. It's not relevant to the startup at the specific stage we look at in our application process. So by having the lean canvas, it helps you prioritize, again, coming back to it, what the riskiest assumptions are, where the risk of the business is. Because if you're able to remove existential risk as fast as you can, then by default, you're more likely to succeed. So that's kind of one of the driving factors of why we use it as well. And as well, additionally, it helps you as a founder be able to craft the right kind of process and experiment to go and prove whether the things you're saying is correct or not. Yeah. So, for example, if the customer box is there and you're saying your early adopter box that your business is looking to target X, well, if that's kind of what we're seeing is the riskiest thing here, we're not clear on what that is. It's very easy for you to build that out and test that. And it's very simple to look at, as opposed to looking through 80 pages of a document trying to find that specific thing, which is alluding to the big risk.
Okay, so what's the best practice for writing a lean canvas?
Ooh.
Don't start with solution.
Yeah, I think it's, how to write the perfect business plan. I think detail in the right place is really important. I think Dan alluded to it then. If your solution box is massive, but your understanding of the customer is really small, like that's not a well-balanced canvas. So what does a great canvas look like? It's very focused. There's only a few points in each box, and those are all business critical activities. You've started with the riskiest assumption first, which is usually quite linear. It means, is there a problem and for who? And then you work on to, and how would I solve that problem? How would I market that problem? How would I monetize? So starting in the right places, and it's okay to have risks later on in the business. It's okay to not know what your unfair advantage is. It's okay to not know exactly what your go-to-market strategy is going to be. As long as you can show that your customer understanding, your problem understanding are extremely good. And it's actually very easy for someone like us to tell when you submit a canvas, because we see ones with the absolute bare minimum vague information, and we see some that are really well thought out, really well considered, and the difference is completely night and day. What else is best practice? Keep it updated. If I ask you to see a canvas and you tell me, well, I haven't updated it in 5 weeks, what's the point? It takes a few minutes to update. That's the whole point. So like Dan said, keep it current. This isn't a canvas for 12 months from now. We'll have hopefully moved on to some more meaningful business tools actually by that point. This is where you are today. What are your current assumptions and what are you doing to move them? And then the final bit, back onto momentum. If you've got Canvas 1, the Canvas post-investment, in my opinion, should look quite different. Because if it doesn't, it means that someone's funded your plan A and not challenged you, which is quite scary. And really, if you've got the right investment partners, you should be much more confident with what's coming out of the process than what came in, meaning that you've kept it updated, you've built momentum, and the business has moved on from Canvas 1 to 2, and you can easily see that transition. So you have to stay updating it, probably once a week. The only way you're going to do that is if you're focused on the right things and you're really, really key drivers in the business, and ultimately think about it linearly. What do I need to get in order to get the next thing? I can't have a solution about a problem. I can't have a channel to market without understanding who my customers are. I can't decide how much I'm going to charge if I don't know how much it's going to cost me to run the business. So, it's taking it, adding a bit of common sense to it. And then ultimately, it's not about what you've written in there as much as it's about articulating the assumptions you've made or the evidence you've collected. So everyone, we like Lean Canvas. So it gives us 9 clear boxes to challenge you on and ask what you know about it. So all of these things are caveated by your ability to explain them later, as always.
Just before we leave today then, any final top tips for applying to a VC?
Sell the sizzle, not the steak, for me. Top tip number 1. So focus on selling the impact of what it is you're trying to do, and not focus on selling in the initial instance specifically what it is. Sell the impact, because it drives more compelling decisions.
My top tip would be, you want to give the impression to the investor that with or without them, you're going to make this company a success. Now that involves getting started before you ask anyone to put any money in, building a minimum viable service, and giving across that matter-of-fact nature of unstoppableness, meaning I'm here today to talk about how we could help each other be successful. But no worries if you don't invest. I know that this is a great business and I'm going to make a success of it. It's simply a matter of what time frame that's against. And actually, they're the deals I'm most excited about because it gives me urgency to invest. It makes me think if I don't help this person now, they're going to move past the point where I can help. And that's a great deal gone. What you don't want to be investing in is, I can't get this company to work unless you give me money. That it should be an amplifier, not an enabler. So anytime in any situation you give them the impression that no matter what this meeting turns out to happen, I know my business is going to succeed because I'm going to keep working on it and I'm going to keep pushing through whether you fund me or not. That is the single bet. Play hard to get, essentially, is the best way to get investors interested. If you let them know that they have all the power and that if you don't give them money, they can't continue, you know, that doesn't sound like a very sustainable business anyway, or a very committed person. So that would be my top tip, is act like you don't need them, even if you do.
For me, it's about mindset. It's not about the story that the entrepreneur wants to tell. It's what the investors need to hear to be able to invest.
Yeah, and you've got to be careful when you do that, don't you?
One of the best examples I've heard of this is where people are saying, well, I've got lots of other investors interested. And then the immediate question is who? And then if you're not willing to tell them, they know that you're not telling the truth. If you tell them people's names and they are not interested, they'll find out, et cetera, et cetera. So again, that affects your integrity. So, but just be very careful about white lies and maybe exaggerations that are going to make you look foolish.
Yeah. Okay, so thanks for your time today, guys. I feel like we've covered everything you need to know about VCs. If we've missed anything, though, pop them in the comments below and we'll get the guys to answer them after. So see you later.
All right. See you later, everyone.
Thanks. See you later.
Bye.
Bye.